Imagine, if you will, a referee who steps onto a football pitch.
Right.
They've got their whistle, they've got their red and yellow cards, and they're, fully prepared to enforce the rules of the game.
Right.
But then they look around and realize the players don't actually know how to play. There is no ball.
Yeah.
There are no goalposts. In fact, the stadium hasn't even been built yet. So what does that referee do?
That is the ultimate question, isn't it?
Exactly. Do they just stand there blowing the whistle at an empty field?
Mm-hmm.
Or do they put down the whistle, pick up a shovel, and, start pouring the concrete themselves?
It's a fantastic analogy. It really is. And it perfectly captures the sort of the paradox we're looking at today. Because when we typically think of a central bank, whether it's the Federal Reserve or the Bank of England, we think of that referee.
Yeah, the watchdog.
Right. We expect them to play a purely disciplinary supervisory role. They set the interest rates, they blow the whistle on inflation, they monitor the commercial banks, they regulate a game that is already well underway.
Right, they are the traffic cop. But when you look at the history of the Reserve Bank of India, especially in its formative decades, that traffic cop metaphor completely falls apart.
Completely.
You realize you aren't just looking at a regulator, you're looking at a massive, proactive, hands-on architect of an entire national economy. The RBI looked at the post-independence landscape, realized the financial markets simply didn't exist in a way that could support a modern nation, and, decided to build them from the ground up.
And that is a fascinating departure from traditional orthodox central banking. Globally, central banks usually step out of the market, but the RBI, they step directly into
the mud, basically.
Yeah, exactly. They incubated specialized financial institutions, funded them, managed them, and eventually spun them off. It is the absolute definition of institutional architecture.
And that is our mission for this deep dive. Whether you're actively studying the financial plumbing of the Indian economy for an exam, or you're just insanely curious about how a nation actually constructs its financial machinery out of thin air, you're in the right place.
Absolutely.
We are going to deconstruct exactly how and why the RBI built these massive institutions. We're creating an audio blueprint for you today. We aren't just going to list acronyms and dates.
But there will be dates.
There will definitely be dates. But we're going to get into the underlying mechanics. Why do these entities exist? What economic disasters were they trying to prevent? How do they actually work?
The why is the most crucial part. Because none of these institutions were created in a vacuum. They were born out of very specific, often urgent, macroeconomic bottlenecks. To understand the institutions, you have to understand the problems of the era.
Okay, let's unpack this. Let's start with the most fundamental problem of all. Before you can build massive digital payment networks or fund multi-billion-dollar steel plants or create advanced economic think tanks, you need money in the system.
You do.
And in a banking system, money comes from everyday people depositing their savings. But why would anyone hand over their hard-earned cash to a bank if they don't trust it?
They wouldn't. Simple as that. And that brings us to the bedrock of any financial system, which is trust. Trust is the actual currency of banking.
Right.
If you look at the early 1960s, the banking sector in India was still finding its footing. There were vulnerabilities. And in a fractional reserve banking system.
Which is what the whole world uses.
Right, which the whole world uses. Banks don't keep all your money in the vault. They lend most of it out to businesses to drive the economy.
Which means if every single depositor shows up on a Tuesday morning and demands their money back at the exact same time,
the bank goes bust.
A classic bank run.
Exactly. It's a psychological phenomenon as much as an economic one. A rumor starts, panic sets in, and perfectly healthy banks can be destroyed in a matter of days simply because of a liquidity crunch.
So the money isn't gone, it's just tied up in loans.
Precisely. The RBI realized that if they wanted to mobilize the savings of millions of everyday citizens to fund national development, they had to guarantee the safety of those savings. The citizen needed to know that even if the bank failed, their money was safe.
So enter the first major piece of our blueprint. In 1962, the RBI creates the Deposit Insurance Corporation.
Yes.
This is the first major safety net. It fundamentally changes the psychology of the retail depositor. You're no longer just trusting the local bank manager. You're relying on a guarantee backed by the institutional weight of the system.
But protecting the depositor was really only half the battle. You also have to think about the behavior of the banks themselves. Once banks have these deposits, where do they lend them?
Naturally, commercial banks are, pretty risk-averse.
Highly risk-averse. They want to lend to established, wealthy corporations with lots of collateral. But a developing economy needs credit to flow to riskier, crucial sectors, like small farmers or new small-scale industries.
I mean, if I'm a commercial bank manager in 1965, I am not lending to a small farmer who might lose his entire crop to a bad monsoon. The risk is simply too high.
Precisely. So, to alter the behavior of the banks, the RBI established the Credit Guarantee Corporation. This was in 1971.
Okay, 1971.
This entity basically told the banks, hey, if you lend to these priority sectors, these small businesses and farmers, and they default, we will guarantee a portion of that loss.
Oh, wow.
Yeah, it acted as a shock absorber for the banks, incentivizing them to push credit down to the grassroots level where it was desperately needed.
I see. So you have the Deposit Insurance Corporation from 1962 protecting the everyday saver, and you have the Credit Guarantee Corporation from 1971 protecting the banks so they take necessary risks.
Correct.
But managing these two separate entities must have been incredibly complex.
It was. And strategically, they are two sides of the same coin, which is risk management. Protecting deposits and guaranteeing credit both serve to stabilize the banking system. So in 1978, the RBI did something highly pragmatic. They merged the two entities.
Creating the Deposit Insurance and Credit Guarantee Corporation, the DICGC.
Yeah, DICGC, yes.
And this is a crucial detail for anyone trying to understand the legal plumbing here, especially for your exam prep. The DICGC is a wholly owned subsidiary of the RBI. Let's break that down. Because wholly owned subsidiary sounds like corporate jargon, but it has profound implications.
It absolutely does. A wholly owned subsidiary, or WOS, means the RBI holds 100% of the equity capital.
So no private money at all.
None. There are no private shareholders. There are no other institutional investors. The Reserve Bank of India has complete unilateral control, and therefore it bears the ultimate financial and operational responsibility.
Right.
By structuring the DICGC as a WOS, the RBI sent an unmistakable signal to the market. They were saying the central bank itself is the ultimate backstop of the Indian banking system.
Okay, so the foundation is poured, the safety net is securely in place, people are depositing their money, and banks have a mechanism to lend it out a bit more bravely. But everyday commercial banking isn't enough to build a nation's infrastructure, is it?
No, not at all.
If you want to build heavy industries, factories, power plants, dams, you run into a massive structural problem in standard banking.
The asset-liability mismatch. This is perhaps the most critical concept to grasp when looking at economic development.
Let's dissect this because it's fascinating. Walk us through how an asset-liability mismatch actually occurs.
Sure. Imagine you are a commercial bank. Your liabilities are the deposits that people give you. They are liabilities because you owe that money back to the depositors.
Okay, that makes sense.
Now, most of these deposits are short-term. A savings account can be withdrawn tomorrow. A fixed deposit might mature in 1, 2, or maybe 5 years. So your liabilities are generally short-term.
Right. My money is liquid. I want it when I want it.
Exactly. Now look at your assets. Your assets are the loans you give out.
Because they generate interest for the bank.
Right. If an industrialist comes to you and says, I want to build a massive steel plant, well, that steel plant will take 5 years just to build, and probably another 10 years to generate enough profit to pay back the loan.
Wow.
That is a 15-year long-term asset.
So if I use the short-term deposits from my customers to fund a 15-year steel plant loan, and suddenly my customers want their money back next year, I'm trapped.
You are completely trapped.
I can't ask the industrialist to liquidate a half-built steel plant to pay back my depositors. I am completely insolvent, even if the steel plant is a great idea.
That is the asset-liability mismatch, borrowing short and lending long. It is the quickest way for a bank to destroy itself. And because of this, commercial banks in the 1960s simply could not fund the massive, heavy industrialization that India required.
They just couldn't take the risk.
Right. They were structurally incapable of providing what we call term finance, which is long-term loans for big capital projects.
Which forced the RBI back into the role of architect. If the commercial banks can't do it, we have to invent a new kind of bank that can. This brings us to the era of the development finance institutions, the DFIs.
Yes.
And 1964 was an incredibly busy year. Let's add this to the blueprint.
1964 was the watershed moment for institutional finance in India. The RBI recognized two massive gaps in the market, one at the very top of the industrial food chain and one at the very bottom with the retail consumer. And they launched two massive institutions simultaneously to bridge them.
Let's start with the top. To solve that asset-liability mismatch for heavy industry, the RBI creates the Industrial Development Bank of India, the IDBI.
The IDBI was designed to be the apex institution for term finance to industry.
Apex meaning at the very top.
Exactly. Unlike a commercial bank that relied on short-term retail deposits, the IDBI was capitalized differently. It received direct funding, lines of credit, and support from the RBI and the government.
So its money was inherently long-term.
Yes. This allowed it to have long-term liabilities, which meant it could safely issue long-term assets. Those 15-year loans for steel plants, textile mills, and infrastructure projects. It became the primary engine for industrializing the nation.
But the RBI didn't just look at the billionaires and the heavy industrialists. In that exact same year, 1964, they looked at the average middle-class citizen who wanted to grow their wealth but had no safe way to do it.
Right.
And they created the Unit Trust of India, the UTI.
UTI is a phenomenal piece of financial engineering. Before UTI, if a regular person in India had some savings, what did they do with it?
Bought gold.
They bought gold, they bought physical real estate, or they just kept cash under the mattress.
Which is dead capital.
Yeah.
It's safe for the individual, maybe, but it does absolutely nothing for the national economy. It's just sitting there.
Exactly. It's economically inert. The stock market existed, but it was essentially a closed club. It was opaque, highly volatile, and far too risky for a middle-class school teacher or a shop owner to navigate.
Too much friction.
UTI changed the paradigm entirely. It was essentially the birth of the mutual fund industry in India.
So how did UTI actually work mechanically to bring that school teacher into the market?
UTI allowed small investors to buy units. UTI would take the small amounts of money from thousands of everyday people, pool it together into a massive fund, and then professional fund managers would invest that massive pool into a diversified portfolio of corporate stocks and bonds.
So the risk is spread out.
Exactly.
If one company goes bankrupt, the school teacher doesn't lose her life savings because UTI holds shares in 50 different companies.
Precisely. It offered the retail investor safety through diversification, professional management, and a decent return on their savings. But from a macroeconomic perspective, what UTI actually did was channelize the scattered, inert savings of the Indian middle class directly into the capital markets.
Providing the equity funding that Indian corporations desperately needed to grow.
You got it.
It's a brilliant two-pronged attack in 1964. You have UTI mobilizing the equity capital from the retail masses, and you have IDBI providing the heavy term loan debt from the top down.
And this raises a really interesting philosophical point about the RBI's strategy. You mentioned earlier the idea of a tech incubator. That analogy is highly relevant here.
Yeah, because if the RBI is the parent setting up all these institutions, I have to wonder, are these entities meant to be permanent fixtures of the central bank?
That's the question.
Are they like children that stay in the house forever, or do they eventually grow up and move out? Because IDBI, for example, isn't just a DFI anymore.
No, it's not. And that is the ultimate proof of the RBI's success as an incubator. A central bank didn't want to run IDBI forever. They stepped in because there was a market failure. The private sector couldn't provide term finance.
Right.
But over the decades, as the Indian financial system deepened, as capital markets became more sophisticated, the need for a pure government-backed DFI began to wane. Commercial banks got better at managing risk. Corporate bond markets developed.
So the environment changed.
It did. So what happened to IDBI? It evolved. It transitioned from being a specialized development finance institution into a universal commercial bank.
It's a successful spinoff.
Exactly.
The RBI built it, nurtured it until the market could sustain it, and then let it operate independently. That is such a dynamic way to view a central bank. All right, so for you listening, if you're mapping this out for your exam, group these DFIs by their target sectors.
That's a good strategy.
We had the 1960s with heavy industry and retail capital. But if you look at the demographic reality of India, you're looking at a deeply agrarian society. You can build all the steel plants you want, but if the agricultural sector collapses, the country starves.
Which brings us to the next massive bottleneck. Commercial banks, even after nationalization, historically struggled with agricultural credit.
Why is that?
Farming is completely different from manufacturing. It relies on the monsoon, which is unpredictable. The cash flow is seasonal. Farmers only get paid after the harvest. And the collateral is often fragmented land.
It's a commercial banker's nightmare. You can't put a farm on a spreadsheet the way you can put a factory's output on a spreadsheet.
Exactly. The RBI had made earlier attempts to address this. They had an entity called the Agricultural Refinance Corporation, but it was somewhat fragmented. As the rural economy grew, it demanded a much more powerful, centralized, and dedicated institution.
So they needed an upgrade.
Big time. And so in 1982, the RBI established NABARD, the National Bank for Agriculture and Rural Development.
And a crucial point here for anyone mapping the institutional history. NABARD essentially swallowed the older Agricultural Refinance Corporation. It took over its functions and vastly expanded upon them.
Yes, NABARD became the apex body for the entire rural financial ecosystem. It didn't just lend directly to farmers, it provided massive refinance support to regional rural banks and cooperative banks.
Refinance support, meaning they gave money to the banks that give money to the farmers.
You got it. It essentially pumped liquidity into the specialized local institutions that actually understood the local agrarian dynamics.
So it's like a central bank for the rural banks.
That is a very accurate way to describe it. And 1982 wasn't just about looking inward at the rural heartland. In the exact same year, the RBI looked outward at the global horizon.
Oh, right.
They established the Export-Import Bank of India, commonly known as EXIM Bank.
Another targeted intervention. Why does international trade need its own specialized bank? Why can't a regular commercial bank handle a letter of credit for an exporter?
Because international trade finance carries unique cross-border risks. You're dealing with foreign exchange fluctuations, sovereign risk.
Like, what if the country you're exporting to undergoes a revolution or defaults on its debt?
Exactly. And highly complex international shipping and settlement laws. An exporter trying to break into a new emerging market in Africa or Latin America might find that standard Indian commercial banks are completely unwilling to underwrite that risk.
Too many unknowns.
Far too many. EXIM Bank was created specifically to take on those cross-border risks and facilitate the globalization of Indian business.
It is fascinating to watch this matrix expand. We have industry in 64, we have agriculture and global trade in 82. As the 80s close out and the 90s begin, the RBI keeps identifying these specific structural gaps and plugging them with bespoke institutions.
Yes, the momentum continues into the specific sectors of housing and small enterprises. In 1988, they established the National Housing Bank, the NHB.
Now, housing is the ultimate asset-liability mismatch, isn't it? A mortgage is a 20 or 30-year loan.
The absolute extreme of the mismatch. Without a dedicated housing finance apex body to regulate and refinance housing finance companies, the dream of middle-class homeownership would have been virtually impossible to scale in India.
So NHB was the catalyst there.
The NHB provided the regulatory framework and the wholesale funding that allowed retail housing finance companies to flourish.
And then shortly after, in 1990, we see the creation of KZIB, the Small Industries Development Bank of India.
This was a critical recognition of the MSME sector, micro, small, and medium enterprises. These are the lifeblood of employment in India. But a small auto parts manufacturer in Chennai or a textile weaver in Surat often lacks the pristine balance sheets required by large commercial banks.
They just don't have the paperwork.
Right. ETSA was carved out to focus exclusively on their credit needs, offering tailored financial products and developmental support.
And rounding out the historical DFIs, we have the Industrial Investment Bank of India, IEBI, established in 1997. So if you're visually mapping this in your mind, you can literally see the RBI systematically walking through the entire economy. Industry, retail savings, agriculture, exports, housing, small businesses, they left no stone unturned.
But we must be careful not to talk about this as if it's purely ancient history. The philosophy of the RBI acting as an institutional architect is very much alive today.
Oh, absolutely. Fast forward to 2021. The Indian economy is vastly larger, deeply integrated with the global market, but it still faces a massive perennial challenge. Infrastructure. Always infrastructure. Multi-billion-dollar highways, ports, green energy grids. The capital requirements are astronomical.
And once again, despite having large commercial banks, the sheer scale and the long gestation periods of modern infrastructure projects presented that familiar hurdle. The market needed a new, specialized heavyweight.
Enter NABI-FID, the National Bank for Financing Infrastructure and Development, set up in 2021.
NABI-FID is a fascinating modern case study. It was established by a specific act of Parliament, the NABI-FID Act of 2021, to be the principal entity for infrastructure financing. But what's truly interesting for our deep dive into the RBI's mechanics is how it's regulated.
Right, because setting up a massive infrastructure bank is one thing, but who watches the watcher? Who ensures that NABI-FID itself doesn't take on reckless risks?
The RBI, of course. In March 2022, a critical notification was issued regarding its regulatory status. NABI-FID was classified to be regulated and supervised as an All-India Financial Institution, or AIFI.
Let's unpack the term AIFI for the listener's blueprint. It sounds very official, but what does that regulatory status actually allow the RBI to do?
It's grounded in very specific statutory power. Specifically, NABI-FID is regulated under Sections 45L and 45N of the Reserve Bank of India Act, 1934.
Okay, 45L and 45N.
Now, without getting bogged down in legalese, what those sections fundamentally mean is that the RBI has the explicit legal authority to call for information from NABI-FID to direct its policy and, critically, to physically inspect the institution.
Wow.
It brings this massive modern infrastructure behemoth firmly under the supervisory umbrella of the central bank.
It proves that the RBI never truly drops its referee whistle, even when it's helping build the stadium. It creates the DFI, but maintains the statutory power to audit the books.
Exactly.
So let's take stock. We have solved the trust issue with deposit insurance. We have pumped billions of rupees into every sector of the economy, from steel plants to rural farms to modern highways, through this sprawling network of development finance institutions. The money is flowing.
The physical pipes are laid.
But suddenly the RBI hits a completely different kind of bottleneck. And it's not a financial one, it's an intellectual one. You can build all the banks in the world, and you can fill their vaults with cash. But who is actually going to manage them?
That's the million-dollar question.
How do you run complex monetary policy in a rapidly changing economy if you don't have the specialized human capital to understand it?
It is the classic problem of scaling. You can scale capital much faster than you can scale human expertise.
Right.
The RBI realized that creating financial institutions without creating the intellectual frameworks to govern them was a recipe for disaster. They didn't just need bankers. They needed visionaries, researchers, and highly trained operational managers.
Which forced the RBI into yet another unexpected role, the educator and the think tank sponsor. We're shifting now from the physical flow of money to the creation of what we can call the brain trust.
The brain trust, I like that.
And the timeline here is deeply intertwined with the political history of India. Let's look at 1969.
1969 is arguably one of the most consequential years in Indian economic history. It was the year of the first major wave of bank nationalization.
The government took over the largest private commercial banks.
Yes. Suddenly, the mandate of these banks changed overnight. They were no longer just supposed to serve wealthy urban clients. They were ordered to rapidly expand their branch networks into deep, unbanked rural areas.
Right. They had to open thousands of branches in villages that had never seen a bank before.
Exactly. And the existing bank managers were completely unequipped for this. They knew how to underwrite a loan for a textile mill in Mumbai. They had no idea how to assess the creditworthiness of a dairy cooperative in a small village.
It's a completely different skill set.
Entirely. The sheer complexity of bank management scaled up exponentially overnight.
The system was flying blind. So the RBI steps in. In that same year, 1969, they established the National Institute of Bank Management, the NIBM, located in Pune.
NIBM was designed to professionalize bank management. It wasn't just about teaching basic accounting. It was about creating a cadre of leaders who understood the mechanics of modern banking, developmental economics, and operational efficiency.
So it was like a university for bankers.
It was a factory for producing the intellectual capital required to run a rapidly expanding nationalized banking sector.
But India is too vast and too diverse to centralize all its learning in one city in the West. You can't just train people in Pune and expect them to seamlessly manage banking in the Himalayas or the deep Northeast.
The RBI recognized that geographic nuance is critical in finance. A credit model that works in the plains of Maharashtra might fail completely in the hilly, distinct economic landscape of the Northeast.
Right.
So in 1980, they established the Indian Institute of Bank Management, the IIBM, and the location here is the key data point, Guwahati.
A deliberate move to build capacity specifically for the northeastern region.
Yes. The IIBM was sponsored by the RBI alongside other financial institutions, specifically to cater to the capacity-building needs of banks in the Northeast. It ensured that the human capital was tailored to the regional realities of the economy.
Okay, so by the 1980s, the operational management of the banks is being handled. The branch managers are getting trained. But as the Indian economy matured, just running the day-to-day operations of commercial banks wasn't enough for the central bank. The RBI was dealing with massive, structural, macroeconomic questions.
Inflation dynamics, poverty alleviation, the impact of global oil shocks.
Right.
They needed deeper, more rigorous economic insights. And so in 1987, the RBI made a very bold move. They established the Indira Gandhi Institute of Development Research, or IGIDR, and crucially, it was fully funded by the Reserve Bank.
Now, here's where it gets really interesting. I have to push back on this because it seems a bit counterintuitive.
Yes.
Well, the RBI is a massive institution. It already has its own internal economic departments. It has armies of statisticians and monetary policy experts on its payroll. Why on earth does a central bank need to spend its own money to fully fund an independent research institute outside of its own walls? Why not just hire more economists internally?
It's a brilliant question, and the answer cuts to the core of behavioral economics and institutional psychology. Think about the danger of the echo chamber.
The echo chamber.
Yeah, if all of your macroeconomic research is generated entirely by internal staff who report to the senior management of the central bank, there is an enormous, often unconscious pressure to validate the existing policy biases of the leadership.
I see where you're going with this.
Right. If a governor believes a certain monetary policy is correct, an internal junior economist is highly unlikely to publish a paper tearing that policy to shreds.
It's career suicide to tell the boss their entire economic worldview is mathematically flawed. So you get groupthink. Everyone just nods and agrees, and the central bank becomes blind to its own mistakes.
Precisely. Groupthink is the enemy of sound monetary policy. By fully funding an independent entity like IGIDR, the RBI essentially bought itself an intellectual hedge.
That's fascinating.
IGIDR scholars are not RBI employees. They have academic freedom. They can build dissenting economic models. They can critique central bank policy. The RBI recognized that to make the best decisions, it needed a stream of rigorous, external, unvarnished macroeconomic analysis. They funded the very people who might tell them they are wrong.
That is incredibly progressive. It's like a tech giant funding an open-source, independent lab to explore the frontiers of computer science, knowing that the lab might invent something that disrupts the tech giant's own business model. You want the smartest minds exploring the horizon without corporate constraints.
And speaking of exploring the technological horizon,
Right.
we have to talk about what happened in 1996. Because if there's one moment that proves the RBI's ability to look around corners, this is it.
1996,
Yeah.
the creation of the Institute for Development and Research in Banking Technology, IDRBT, set up as a wholly owned subsidiary of the RBI.
Put yourself in 1996. The internet was barely out of its infancy. People were using screeching dial-up modems, digital banking, mobile payments, the idea of instantly transferring money through a phone. These concepts were practically science fiction to the average consumer.
Most banking was entirely paper-based.
Yeah.
Ledgers, passbooks, physical signatures.
And yet, in that environment, the central bank of a developing nation decides to establish a dedicated, massive research institute solely focused on banking technology.
It's wild. They realized the plumbing of the economy was about to go digital.
Exactly. IDRBT was tasked with researching networking, security, and payment systems. The intellectual groundwork laid by IDRBT in the late 90s and early 2000s became the foundational bedrock for the massive world-leading digital payment revolution that India would experience decades later. They didn't wait for the technology to arrive and disrupt them. They built the lab to understand it first.
And rounding out this intellectual evolution, we arrive at 2011. The world is still recovering from the devastating 2008 global financial crisis. The rules of global finance are being rewritten. India's economy is now massive, highly interconnected, and deeply integrated into global capital flows.
And to navigate this new, highly complex global reality, the RBI promoted CAFRAL, the Center for Advanced Financial Research and Learning.
Again, set up as an independent think tank, and again, fully funded by the RBI. But the mandate here feels different than the others.
It is distinctly global. While NBM focused on operational management and IGIDR focused on developmental macroeconomics, CAFRAL was established with the explicit goal of evolving into a global center of excellence for research in banking and finance.
So zooming way out.
Right. It was about positioning Indian regulatory and financial thought leadership on the world stage, engaging with global systemic risks, and learning from advanced international financial markets.
So if we trace this evolution in our blueprint, it perfectly mirrors the maturation of the Indian economy itself. In 1969 with NIBM, the RBI is teaching basic branch managers how to do their jobs. By 1987 with IGIDR, they are seeking independent macroeconomic modeling.
Tracking perfectly.
By 1996 with IDRBT, they are pioneering the digital frontier. And by 2011 with CAFRAL, they are engaging in a high-level global financial strategy. The RBI built an entire university system, essentially, to ensure the minds running the economy were as sharp as the capital flowing through it.
It is a stunning intellectual architecture.
So let's pause and look at the ecosystem we've built so far. We have the safety nets catching the falls. We have the massive DFIs pumping capital into industry and agriculture. We have the think tanks generating the brilliant ideas and training the managers.
We've got a lot.
But there is a missing piece. If a bank in Mumbai has a surplus of cash and a bank in Delhi desperately needs cash overnight, how do they actually interact? You can't just have smart people holding bags of money. You need a secure, highly efficient physical and digital space for them to actually trade, clear, and settle these transactions.
You're describing the necessity of market infrastructure. Without efficient markets, capital doesn't flow to where it's needed. It just pools and stagnates.
Which brings us to the market makers and the digital plumbers, the actual mechanical infrastructure of the financial system. And let's start with the concept of a market maker. In March 1988, the RBI, jointly with public sector banks and financial institutions, sets up DFHI, the Discount and Finance House of India Ltd. Why?
To understand DFHI, we need to understand the money market. Now, when most people hear market, they think of the stock market, buying shares of companies. The money market is entirely different.
Okay, clarify that for us.
It is the wholesale market for highly liquid short-term debt instruments. We are talking about transactions that mature in a few days or sometimes just overnight. Banks use the money market to manage their daily liquidity.
So if a bank realizes at 4:00 p.m. that it has a temporary cash shortfall and needs a quick loan until the next morning to meet its regulatory requirements, it goes to the money market.
Exactly. But in the late 1980s, the Indian money market was incredibly sluggish. There was very little secondary trading. If an institution held a short-term financial instrument and suddenly needed cash, it was incredibly difficult to find a buyer quickly. The market would freeze up.
Think of it like owning $1 million painting, but you're starving and need to buy a sandwich right now.
Right.
The painting is valuable, but it's not liquid. You can't instantly trade it for cash.
That's a great way to put it. You need liquidity. And that is exactly what DFHI was created to provide. DFHI was mandated to be a market maker.
What does a market maker actually do mechanically?
A market maker stands in the center of the trading floor, so to speak, and says, I will always quote a price to buy from you, and I will always quote a price to sell to you. They hold an inventory of these financial instruments.
So they always open for business.
Right. Because DFHI was always there, ready to trade, banks knew they could always liquidate their short-term instruments instantly. DFHI lubricated the gears of the system, ensuring that temporary cash shortages didn't cause banks to panic.
They are the ultimate buyers and sellers of last resort for the short-term market. And once the RBI solved the short-term money market, they turned their attention to the long-term debt market, specifically the market for government securities, or GSECs.
Yes. In 1994, the RBI promoted the Securities Trading Corporation of India, the STCI. Its objective was to foster the development of an active secondary market for government securities and bonds.
Let's clarify primary versus secondary markets for our listeners, because it's a vital distinction for the blueprint.
Okay, so when the government needs to borrow money to build roads or fund the deficit, it issues a bond. When an institution buys that brand new bond directly from the government, that is the primary market. But what happens if that institution wants to sell that bond 3 years later to another bank?
That's the secondary market, trading secondhand bonds.
Exactly. And a vibrant secondary market is crucial. If banks know they can easily sell a government bond whenever they want in the secondary market, they are far more willing to buy them from the government in the primary market in the first place.
It reduces the friction.
Yes. STCI was created to provide that deep liquidity and active trading environment for government debt, effectively making it easier and cheaper for the Indian sovereign to fund its development.
Okay, so DFHI and STCI are the market makers. They are playing the game, actively buying and selling to keep the capital moving. But as the volume of these trades exploded into the billions and trillions of rupees, a new terrifying risk emerged. And this is where we get to one of the most critical yet underappreciated institutions in modern finance, the Clearing Corporation of India Limited, CCIL, established in 2001.
CCIL is the unsung hero of Indian financial stability. It was set up by banks, financial institutions, and primary dealers. Its fundamental role is to serve as a central counterparty, or CCP.
Central counterparty.
Right. It offers guaranteed clearing and settlement functions for transactions in money, GSECs, foreign exchange, and derivative markets.
Guaranteed clearing and settlement. That is a dense sentence. Let's really break this down. What is the actual nightmare scenario that CCIL was built to prevent?
The nightmare scenario is called counterparty settlement risk. Let's walk through a highly simplified scenario.
Walk me through it.
Bank A agrees to buy 100 million rupees worth of foreign exchange from Bank B. They shake hands, digitally speaking, and agree to settle the trade the next day. Bank A sends the money. But overnight, before Bank B can send the foreign exchange, Bank B goes bankrupt. It collapses.
Oh, man. So Bank A is out 100 million rupees. They paid, but they didn't receive the asset.
Yes, but it gets worse. Because Bank A lost that 100 million, they might now be unable to pay Bank C for a completely different trade, and Bank C then defaults on Bank D.
A domino effect.
Exactly. In a highly interconnected financial system where thousands of massive trades happen every hour, the failure of one major player between the time a trade is agreed upon and the time it is settled can cause a catastrophic domino effect. The entire system can freeze and panic. This is systemic risk.
So how does CCIL stop the dominoes from falling?
Through a legal mechanism called novation. When Bank A and Bank B agree to a trade, CCIL instantly steps directly into the middle of it. The original contract between Bank A and Bank B is legally torn up.
Wait, torn up?
Yes, conceptually. Two new contracts are created. CCIL becomes the buyer to Bank B, and CCIL becomes the seller to Bank A.
Think of it like a high-stakes real estate transaction. You don't just hand $1 million in cash to the seller and hope they hand you the keys. You use an escrow service.
Yeah.
The escrow holds the money and the deed, ensuring both sides deliver before anything is released.
It's very similar, but on an industrial scale. Or think of a casino. When you sit at a poker table, you aren't actually betting against the other player's cash. You exchange your cash for the casino's chips. The casino guarantees the value of the chips.
Right.
If the player across from you loses a massive hand, flicks the table, and runs out of the building, you don't lose your winnings. The casino pays you.
Ah, I see.
CCIL is the casino. It legally guarantees the settlement of the trade. If Bank B goes bankrupt overnight, CCIL absorbs the loss and honors the commitment to Bank A. The systemic contagion is stopped dead in its tracks.
It acts as the ultimate shock absorber for the wholesale financial markets. CCIL ensures that the big banks can trade with each other with absolute confidence.
Completely.
But what about the rest of us? CCIL is handling multi-million-dollar interbank trades. But as India modernized, the sheer volume of retail transactions, people buying groceries, transferring money to family, paying bills, that became a massive infrastructural challenge.
And that leads us to 2008 and the creation of an institution that has profoundly impacted the daily life of nearly every single Indian citizen, the National Payments Corporation of India, the NPCI.
NPCI,
Mm-hmm.
the umbrella organization for operating retail payments and settlement systems, the entity behind the UPI revolution. And the vital point here for your exam prep is that it was set up with the direct guidance and support of the Reserve Bank of India and the Indian Banks Association, the IBA.
The creation of NPCI is a masterclass in strategic foresight. The RBI realized that having fragmented proprietary payment systems operated by individual banks or foreign credit card networks was inefficient, expensive, and potentially a sovereign risk.
So they needed to standardize it.
They needed a unified, domestic, interoperable digital rail for retail payments.
It is genuinely staggering to think about. Every single time a person in India scans a QR code at a tea stall to pay 10 rupees from their mobile phone instantly, they are riding on digital rails that were envisioned, guided, and incubated by the central bank back in 2008.
It's remarkable.
But wait, I have to challenge this setup. Let's look at the immense power the RBI is wielding here.
Mm-hmm.
They created NPCI, setting the rules for retail payments. They fostered CCIL, effectively regulating wholesale settlement. They are the referee, but they are also building the stadium, owning the teams, and selling the tickets.
That's a fair critique.
How does a central bank balance this massive conflict of interest? How do they avoid becoming a monopolistic player that crushes private innovation?
It is a delicate, highly scrutinized balancing act. And the answer lies in the philosophy we discussed earlier, the central bank as an incubator, not an empire builder. The RBI initiates these critical infrastructures because there is a coordination problem.
Oh, coordination problem.
Right. 100 competing private banks would never naturally agree to build a single, unified payment system. They would all try to build their own walled gardens.
Right. Everyone wants to own the toll booth.
Exactly. So the RBI steps in, uses its regulatory authority to force the coordination, and builds the initial infrastructure. But, and this is the key, they don't maintain total ownership forever. They design these entities, like NPCI, to be owned by a consortium of the banks themselves.
Oh, interesting.
They set up independent boards, they gradually step back from daily operations and retreat to their core mandate. supervision and regulation. They intervene to overcome market failure, establish the public good, and then let the market operate it.
They are a catalyst. They spark the reaction and then step away. Okay, so we have the market makers, the wholesale clearers, and the retail payment rails. But as all of this moves into the digital realm, you need actual physical IT infrastructure to run it safely.
You certainly do.
And you need to protect it from hackers, state-sponsored cyber attacks, and systemic outages.
Which brings us to the specialized IT institutions, the digital plumbers of the RBI. And there is a fascinating, highly deliberate contrast between the two main entities in this space.
Let's put them side by side for the blueprint. In 2015, we get IFTAS, the Indian Financial Technology and Allied Services, and 2 years later, in 2017, we get RBIT, the Reserve Bank Information Technology PVT Ltd. Both are heavily involved in tech, but their focuses are entirely different.
It's the difference between protecting the fortress and paving the roads outside it. Let's start with RBIT, set up in January 2017. RBIT is fundamentally inward-looking. Its primary mandate is to take care of the massive IT requirements and, crucially, the cybersecurity needs of the Reserve Bank itself and its regulated entities.
Because a central bank is arguably the most high-value cyber target in an entire nation.
Without a doubt.
If hackers penetrate the RBI's internal systems, they aren't just stealing data. They could potentially manipulate currency reserves, crash the settlement systems, or destabilize the sovereign debt markets.
The threat matrix is terrifying. RBIT is the cyber defense shield. It is dedicated to ensuring that the RBI's internal infrastructure is resilient, secure, and impenetrable against advanced modern cyber threats. It's about systemic survival.
And contrast that with IFTAS, the wholly owned subsidiary set up earlier in 2015. IFTAS is much more outward-looking.
Yes, IFTAS is about the network. It is mandated to design, deploy, and support IT-related services not just to the RBI, but to all banks and financial institutions in the country. If RBIT is building the walls of the fortress, IFTAS is building the secure fiber optic cables connecting all the fortresses together.
So it's about the ecosystem.
Right. Its goal is to provide a highly secure, reliable IT platform that allows the broader financial industry to innovate and, as the mandate says, craft unique digital banking experiences for the consumer.
Two sides of the digital coin. RBIT handles the internal cyber resilience. IFTAS handles the external interconnectedness. Which brings us, incredibly, to our final transition. We've explored the digital frontiers, the macroeconomic think tanks, and the high-speed payment rails. But beneath all of this modern, frictionless digital finance lies a heavy, industrial, highly physical reality. Because despite everything we've talked about, the Indian economy still runs on an unimaginable amount of physical cash.
It is the ultimate juxtaposition in modern monetary economics, the most advanced digital payment systems in the world operating side by side with massive, heavy industrial currency manufacturing.
Let's talk about the printers. In 1995, the RBI established BRBNMPL, the Bharatiya Reserve Bank Note Mudran Private Limited, another wholly owned subsidiary. Its entire purpose is to augment the production of banknotes to bridge the gap between supply and demand. They operate two massive printing presses, one in Mysuru in the south and one in Salboni in the east.
And the vital statistic here, the empirical data point that truly captures the scale of this operation, is their production capacity. They have an installed capacity of 12,000 TPA.
12,000 tons per annum. I want to pause on that number because it is almost impossible for the human brain to comprehend. 12,000 tons of physical paper cash printed every single year.
It's massive.
Just to give you a mental image, a fully loaded Boeing 747 commercial airplane weighs around 400 tons. BRB and MPL prints the equivalent weight of 30 Boeing 747s in pure, highly secure, watermarked currency notes every single year.
The logistics are mind-boggling. You are dealing with highly specialized security paper, complex anti-counterfeiting inks, massive industrial printing presses, and then the staggering logistical challenge of securely transporting those thousands of tons of cash in heavily armored convoys to currency chests spread across a subcontinent of over 1 billion people. It is a logistical operation rivaled only by the military.
But this brings up a massive contradiction, doesn't it? We just spent the last 20 minutes talking about IDRBT anticipating the internet, NPCI revolutionizing digital mobile payments, and IFTAS building digital banking experiences. And to push this even further, look at the institution the RBI set up just recently, in 2022, the Reserve Bank Innovation Hub, RBIH.
Right, RBIH is a fascinating addition. It is a wholly owned subsidiary aimed specifically at accelerating innovation across the financial sector. Its explicit goal is to enable access to financial products and services for 1 billion Indians in a secure, frictionless manner.
Frictionless. They're collaborating with tech startups, applying AI, and trying to make moving money as easy, cheap, and invisible as sending a WhatsApp message. So here is the contradiction. The RBI is aggressively funding and building the very digital technologies that aim to eliminate cash.
Yeah, you see the tension there.
So why maintain BRB and MPL? With NPCI processing billions of UPI transactions, isn't printing 12,000 tons of paper money a massive waste of resources? Is this industrial printing press eventually going to become a relic of the past?
It is a completely logical assumption, but the macroeconomic data tells a very different, highly nuanced story. While the adoption of digital payments in India is growing exponentially, faster than almost anywhere else on Earth, the demand for physical cash has remained stubbornly, remarkably resilient.
Wait, really? Even with everyone using QR codes?
Yes. Economists look at a metric called currency in circulation as a percentage of GDP, and that ratio has not collapsed.
Why not?
Because cash offers utilities that digital money currently cannot. Cash provides absolute anonymity. Cash does not require a smartphone, an internet connection, or an electricity grid, which is crucial in a country where natural disasters or power outages can still occur. And fundamentally, cash holds deep ingrained cultural significance as a store of value, particularly in the vast informal sectors of the economy.
So it's a dual-track strategy.
Exactly. The RBI has to actively manage the heavy physical present while aggressively engineering the agile digital future. They know that while the growth rate of physical currency demand might begin to slow down due to the innovations coming out of RBIH and NPCI, the baseline absolute demand for physical cash is going to remain massive for the foreseeable future.
So the presses keep rolling.
Eliminating those printing presses is not an option anytime soon. True central banking is managing the contradictions of a transitional economy.
Managing the contradictions. I love that. But navigating a transitional economy where you have physical cash on one side and complex digital finance on the other, that presents a massive risk to the everyday consumer. If the financial system is evolving faster than the public can understand it, people get left behind. Or worse, they get exploited.
Which brings us to the final and perhaps most socially vital institution in our exploration, the teachers.
The National Center for Financial Education, the NCFE. Now, if you are analyzing the legal structure of these institutions for your exams, pay very close attention here. This breaks the pattern we've seen so far. NCFE is not a wholly owned subsidiary of the RBI.
No, it is a completely different organizational beast. NCFE is structured as a Section 8 company. Under Indian corporate law, a Section 8 company is a not-for-profit entity.
Not-for-profit, okay.
Its objective is the promotion of commerce, art, science, sports, education, or social welfare. Any profits it might generate cannot be paid as dividends to its members. They must be reinvested entirely into promoting its objective.
It fundamentally protects the mission. The goal is purely education, not revenue generation. But what's even more fascinating than its nonprofit status is who actually created it. It wasn't just the RBI acting alone this time.
No, it wasn't. Financial ignorance is not a banking problem. It is a systemic vulnerability. A consumer who doesn't understand compounded interest or digital security can be exploited by a predatory loan shark, sure, but they can just as easily be sold a fraudulent insurance policy or tricked into a massive loss in the stock market. Financial illiteracy doesn't respect regulatory boundaries.
So the regulators had to cross those boundaries to fight it.
Exactly. NCFE is jointly promoted by a powerful coalition of India's 4 major financial regulators. You have the RBI, representing banking and monetary policy. You have SEBI, the Securities and Exchange Board of India, representing the stock and capital markets. You have IRDI, the Insurance Regulatory and Development Authority. And you have PFRDA, regulating the pension funds.
It is an unprecedented alliance. 4 distinct regulatory watchdogs who usually guard their own specific territories, realizing that the ultimate firewall against systemic risk isn't a better algorithm or a larger cash reserve. The ultimate firewall is an educated consumer.
The vision of NCFE is explicitly stated: a financially aware and empowered India. They are tasked with creating educational materials, running massive national campaigns, and pushing financial literacy into school curriculums.
Because if the RBI is going to use RBIH to build frictionless digital finance and NPCI to process billions of transactions, they have a moral and systemic obligation to ensure the public actually understands how to safely wield these powerful new tools.
Exactly.
All right, take a deep breath. We've journeyed through decades of financial history, economic theory, and institutional engineering, from the 1960s to the 2020s. Let's briefly zoom out and look at the magnificent machinery we've uncovered today. We saw the RBI recognize the foundational need for trust, creating the safety nets of the DICGC to protect deposits and guarantee vital credit.
Yep, solving the bank run problem.
We watched them tackle the crippling asset-liability mismatch by building the massive development finance institutions, the DFIs. They mobilized retail capital through UTI and funded heavy industry with IDBI. They reached deep into the rural farmlands with NABARD, crossed oceans with Exim Bank, built cities with the National Housing Bank, supported the small manufacturer with SEB, and are funding the modern physical infrastructure today with NABI-FAB.
We then saw the realization that capital needs intellect. They built the brain trust, NIBM and IBM to train the managers, IGIDR to provide rigorous, independent macroeconomic reality checks, IDRBT to anticipate the digital revolution years before it happened, and KFRAL to project Indian financial thought leadership onto the global stage.
We explored the hidden plumbing of the market makers, DFHI and STCI providing vital liquidity so the markets never freeze, CCIL acting as the ultimate shock-absorbing central counterparty to stop the dominoes of systemic collapse, and NPCI laying the revolutionary rails for retail digital payments.
And finally, we saw them managing the complex realities of the physical and the digital. The colossal industrial 12,000-ton printing capacity of BRB and MPL operating alongside the frictionless digital ambitions of the Reserve Bank Innovation Hub, all under the protective educational umbrella of the Multi-Regulator Alliance at the NCFE.
The RBI didn't just regulate the Indian economy, they incubated it. They built the stadium, trained the players, invented the ball, and then slowly and carefully stepped back into the referee's box to watch the game flourish. But before we sign off, I want to leave you with one final, slightly provocative thought to consider.
We have spent this entire deep dive tracing a very physical evolution. The RBI built brick-and-mortar development banks with thousands of employees. Then they built physical university campuses for research. Then they built IT companies with sprawling server farms.
It's all very tangible.
But look at the trajectory. As the Reserve Bank Innovation Hub hyper-digitizes finance, and as AI and decentralized networks become more sophisticated, it raises a profound question about what it means to be an institutional architect in the 21st century. Will the RBI's future institution building be entirely code-based?
Oh, wow.
Think about the concept of programmable money. Think about smart contracts on decentralized ledgers. Will the next major institution that the central bank founds even have a physical headquarters? Will it have a board of directors or employees? Or will it simply be a self-executing algorithm? A piece of sovereign digital infrastructure that regulates markets in real time, instantly clears global cross-border payments without a middleman, or automatically provisions liquidity the millisecond a market freeze is detected, completely without human intervention.
That is a staggering thought. Going from managing 12,000 tons of physical paper cash to literally incubating algorithmic institutions that exist only in the cloud. The entire concept of what a central bank actually is continues to mutate. We hope this audio blueprint has fundamentally changed how you view the financial infrastructure around you. The next time you make a digital payment, or see a massive infrastructure project being built, or even just hold a physical banknote in your hand, remember the hidden plumbing and the institutional architects who engineered it into existence. Keep questioning how the system works. Thank you for taking this deep dive with us.